Do you have to be in good health to own an IUL policy? By the end of this video episode, you will understand that you may likely qualify to be the insured even if you have a few health issues. But it's the owner of the IUL insurance policy that gets all the tax-free benefits. You do not have to be the insured to own an IUL policy. So get ready. So I'm Doug Andrew. I've been a financial strategist, retirement planning specialist now for north of 48 years. You probably can surmise that my favorite financial vehicle that allows people to accumulate their money tax-free and then be able to access that money tax-free. And at the end of the day, when you pass away, anything that you leave behind blossoms, increases in value, and transfers income tax-free under 3 sections of the Internal Revenue Code that have been around for over a century is a max-funded indexed universal life insurance policy. The most common question that I get asked in audiences is, well, do you have to be in good health, especially if someone has a few health issues? So in this episode, I'm going to share with you different ways that will sort of calm your concern about if you have to be in good health. Now, I want to start by explaining that when you have an insurance policy, and in this case, we're talking about indexed universal life insurance, where you're designing it primarily, let's say, for living benefits. In other words, instead of trying to pay the least amount of premium for the amount of life insurance protection you want if you die, most people who come to me are doing the opposite. They're taking the least amount of insurance that they can get away with under the IRS rules to put in the most money that the IRS allows as fast as they allow. And those are tax citations called TEF, DEF, and TAMRA. So if you're designing an IUL policy for living benefits primarily, but also you want to take advantage of the tax-free death benefit, that's why I call it a financial Swiss Army knife. You can use it for death benefit, but you can use it for living benefits like the dream solution for retirement or college funding for your kids or working capital for business or real estate investing or whatever. There are 5 parties when you apply for a life insurance policy. Now, first of all, there is the insured. Now, that's the person that the life insurance is put on. That's the insured. Now, generally speaking, the insured is also the owner. And, that might be optimal for most situations where if the insurance is going to be on my life, let's say, and the insurance is $1 million or $10 million, doesn't matter, I probably would like to own that policy. But I don't have to. It could be owned by a family trust, or it could be owned by my wife or my kids or whatever. But see, there are even banks that own life insurance on people. Why? Because they want the tax-free accumulation. They're using somebody else's life to put the insurance on, but they own the policies. And people go, really? Oh yeah. I've owned life insurance on my mother-in-law, father-in-law, my dad. I couldn't on my mother because she had heart disease, but oh yeah, and my kids own them on me. Why? Because the owner gets all of the tax-free benefits. But let's go back to the 5 parties. So if you're the insured, you might be the owner, but you don't have to be. But then we have what? The premium payor. That's the person who is paying the premiums into the policy, or the entity that's paying the premiums. Generally, that is the insured and the owner also. But it doesn't have to be. So far we have the insured, the owner, the premium payor. We have the beneficiary. Okay, the beneficiary is the one that will receive the life insurance proceeds when you pass away. So if I have $1 million policy and I die, the beneficiary that's named in the policy gets the $1 million tax-free when I pass away. And the beneficiary could be a trust, or it could be my spouse or my kids or a church or a charity or whatever. Okay, so now we've covered 4. What's the 5th party? It's the actual insurer, the insurance company. Okay? Now, the insurer has to make sure when you apply for a life insurance policy that there is a need or a reason and justification for the amount of life insurance you're applying for. And so there must be a relationship between the insured and the beneficiary that if you were going to get life insurance, you have to prove that this beneficiary would suffer financially if you were to pass away. You have to prove that that insurable interest is what it's called. You have to justify why this beneficiary is going to suffer economically if you pass away. And that's easy to prove if you're insuring yourself and the beneficiary is your spouse or your kids or your grandkids and so forth. Now, after a policy is issued, you can change the beneficiary to a charity or the Boy Scouts or a hospital or your alma mater. You can change the beneficiary anytime you want because the owner gets to do that. But see, it's the owner that changes anything. Now, the owner is normally the insured, but it doesn't have to be. So, when we talk about being in good health, the insured, if you're in good health as the insured, you should have no problem qualifying. But sometimes people go, oh, I had a heart episode 15 years ago. Well, don't rule yourself out. Sometimes you have to wait 5 years or 7 years, but a lot of insurance companies look at it and go, oh, you had a bypass surgery, it's doing great. And they look at your most recent angiograms or whatever, and they go, no, we'll insure you. Now, they may rate you a little bit, but it doesn't matter because under TEFRA and DEFRA tax citations, if you are rated because of your health, but you're still insurable, you squeeze down the death benefit and you can earn 11% and net 10 just like a 22-year-old athletic marathon running female. That's the beauty behind the parity of TEFRA and DEFRA. Parity means equality. The older you are, the less insurance that's required. I teach in other episodes. And by the way, if you're learning some things here, be sure and share this with somebody who needs to understand this or post a comment, okay? The older you are, the less insurance that's required. So if you're 60, you can put in money into an IUL policy, and if you earned 11, you can net 10, just like a 22-year-old athletic marathon running female. But if they take out an IUL policy, they might have to have more insurance than you do for the same amount of money. But normally young people don't have as much money as older people. It sort of all comes out in the wash. But don't rule yourself out, because I've had people who were diabetic, who had problems, who had surgeries, and they thought they were not insurable, and they actually were. And even if you're rated, you get to squeeze down the death benefit so your rate of return is as good and sometimes even better than a healthy 22-year-old, okay? A lot of people go, really? Yes. But let's say you're uninsurable. Let's say the insurance company, or maybe you shop 2 or 3 companies, and all of them say, no, we don't want to insure you. Don't give up. Remember what I said? There's an owner. Now, you simply can own an IUL policy, and instead of you being the insured, you borrow someone else's life to insure. You could put the life insurance on your spouse, on your children, diversify between all your kids, your grandkids, a business partner. See, I own policies on my kids. My kids own them on me. I've owned them on my mother and father-in-law. Why? Because I own the policy. I put money in there. It's my money. It accumulates tax-free, and I can access it tax-free. And when my mother-in-law, father-in-law pass away, I get that money tax-free. My kids, when I die, they can be automatic millionaires because they own a policy on me. They own policy, but I'm the insured because I had insurance capacity that I wasn't using, and so they bought insurance policies on me. The owner of the insurance policy is the one that gets the tax-free accumulation and tax-free access. The owner is normally the insured, but it doesn't have to be. Does that make sense? So this is called surrogates. So make sure you meet with an IUL professional, and if you have a few health issues, don't worry. It's probably worth checking out to see if you can get approved. And if you get approved even with a rating, they can squeeze down the death benefit and you can get a great rate of return. But if you don't qualify, hey, use a surrogate because you want to own these. And this is why many corporations and banks own life insurance policies on other people, stockholders, boards of directors, and so forth. There's a whole industry of this where people own policies on other people because they want the tax-free benefits. So make sure when you meet with an IUL professional that they are qualified to know how to structure it correctly. And I would recommend that you refer to this book called The Laser Fund. This is like your textbook. It's 300 pages of charts, graphs, and also 62 client stories that shows how a max-funded IUL, if it's structured correctly and funded properly, would be deemed a laser fund. Laser is an acronym that stands for Liquid Asset Safely Earning Returns. This will show you how to diversify. and create the foundation for a tax-free retirement using property structured IUL. If you do not have this book, make sure and claim your free copy by going to laserfund.com or click on the link below. You contribute a nominal amount towards the shipping and handling. I'll cover the rest of that, and I'll fire out a free copy to you. There's also options there to listen and learn and watch and learn. But here is to your brighter future when you meet with your IUL specialist.